They say the market is a casino. They are wrong. A casino is a place of predictable odds where the house always wins because the rules are mathematically sound. The market, however, is a place of human emotion, a chaotic arena where the vast majority of participants consistently fail to grasp the underlying mechanism. I have watched this cycle repeat for decades, and the root cause of failure is always the same: a profound, almost willful misunderstanding of probability and discipline. I am often asked about the secret to success in this endeavor. People expect a complex formula, a hidden algorithm, or a proprietary data source. They are disappointed when I tell them the truth. The secret is the relentless application of logic, the absolute rejection of emotion, and the mathematical certainty of preparedness. Today, we're going to discuss a concept that seems almost too simple, yet is systematically ignored by the emotional investor: the strategic, unemotional holding of cash. The traditional narrative, the one preached by those who mistake conviction for data, is that cash is a drag, a wasted asset, a sign of timidity. This is a profound error. Cash, when viewed through the lens of a quantitative mind, is not a position. It is a mathematical option. It is the ultimate expression of optionality, a non-correlated asset that grants you the power to act when others are paralyzed by fear. The title of this discussion is direct: Always hold cash to prepare for crashes. Cash is king. But let us be clear, this is not a piece of market timing advice. I do not believe in market timing. I believe in systemic preparedness. The emotional investor sees a market crash as a disaster. The quantitative mind sees it as a massive, temporary mispricing event, a sudden, violent shift in the probability distribution that creates an opportunity for asymmetric returns. Without a pre-positioned, non-emotional reserve of capital, that opportunity is mathematically inaccessible. You are merely an observer, a victim of the very volatility you should be exploiting. The failure of the traditional approach is rooted in three fatal mistakes, all of which are psychological, not financial. The first mistake is the pervasive belief that every dollar must be constantly working. This is the cult of 100% allocation. It is a psychological compulsion driven by the fear of missing out, the infamous FOMO, and the desire to maximize every basis point of return in a bull market. The emotional investor views a 3% cash position as a 3% loss of potential upside. The quant views it as a hedge against the unknown unknowns, a necessary friction that lubricates the entire system. Let us consider the mathematics of this. If you are 100% invested, your system is brittle. It has 0 degrees of freedom. When a systemic shock occurs, a black swan event, a sudden policy change, or a geopolitical crisis, your only recourse is to sell into the panic, locking in losses, or to ride the decline, hoping for a recovery. Both are emotional responses. The 100% allocation strategy is a statement of absolute certainty in the present, a certainty that the history of markets has repeatedly proven to be a delusion. My experience in mathematics taught me that a system must have robustness. Robustness is not about maximizing the average case. It is about minimizing the damage in the tail events. A small strategic cash reserve, say 5% to 10%, is the mathematical equivalent of a circuit breaker. It is a non-linear tool. In a normal market, its cost is negligible. In a crisis, its value approaches infinity because it is the only thing that allows you to execute a buy order when the market is offering assets at a 50% discount. The emotional cost of holding cash is a few percentage points of potential return. The cost of not holding cash is the inability to participate in the greatest wealth transfer events of a generation. The choice is mathematically trivial. The second mistake is the conflation of liquidity with opportunity cost. The emotional investor sees cash earning 0.5% in a money market account and laments the lost 10% they could have made in the S&P 500. This is a fundamental miscalculation of risk-adjusted return. Liquidity is a form of insurance. You pay a small premium, the difference between the cash return and the market return, for the certainty of immediate access to capital. The value of this insurance is not constant. It is a function of market volatility. When volatility is low, the insurance seems expensive. When volatility spikes, the insurance becomes priceless. Think of it as a complex option contract. You are holding a perpetual zero-strike call option on every asset in the market with an expiration date that is always tomorrow. The premium you pay is the low yield on the cash. The payoff is the ability to purchase assets at a price that is statistically improbable under normal conditions. In 2008, the market offered a masterclass in this principle. Many institutions were technically solvent but functionally bankrupt because their assets were illiquid and their cash reserves were insufficient. They were forced to sell good assets at fire sale prices to meet margin calls or redemptions. Their mathematical models were sound, but their liquidity model was flawed. They failed to account for the nonlinear cascading effects of fear. My own approach has always been to ensure that the system can withstand a 3 sigma event without needing to liquidate a single position at an unfavorable price. Cash is the buffer that makes this possible. It is the mathematical certainty that you can wait for the probability distribution to normalize. The third, and perhaps most insidious mistake, is the emotional attachment to the status quo. The human mind is wired for continuity. We extrapolate the present into the future. When the market is going up, we believe it will continue to go up. This is not analysis, it is psychological inertia. The quantitative approach demands a constant, cold-blooded assessment of the system's state, independent of its recent performance. We are not interested in why the market is going up. We are interested in the statistical probability of a reversal. And that probability is never zero. The emotional investor is always looking for a reason to be fully invested. They read the bullish headlines, they listen to the optimistic forecasts, and they find comfort in the crowd. The quant, however, is looking for the discrepancy, the moment when the market price deviates from the statistically predicted value. Cash is the tool that breaks this emotional attachment. When you hold cash, you are making a statement. I acknowledge that the current price is not sufficiently attractive to justify a full allocation, and I am prepared for a change in the statistical regime. It is a declaration of independence from the crowd's consensus. It is a rational hedge against the human tendency toward euphoria. Let me share a story, not from the trading floor, but from my time in cryptography and code breaking. When you are trying to decipher a complex cipher, you do not commit to a single hypothesis immediately. You hold back a portion of your computational power, a reserve of intellectual energy, to test alternative keys. If you commit all your resources to a single flawed key, you are stuck. You have no optionality. The cash reserve in finance is the same. It is the uncommitted computational power that allows you to test a new hypothesis, a new investment, when the market suddenly presents a new compelling pattern. The emotional investor is always trying to confirm their existing bias. The quant is always prepared to pivot based on new data. Cash is the fuel for that pivot. Now, let us move from the philosophical to the practical, examining the 4 core lessons on how to integrate this concept of cash as a mathematical option into a disciplined investment framework. The first lesson is that the amount of cash you hold must be a quantifiable variable, not a feeling. It cannot be a number you pull from the air based on a vague sense of unease. It must be a function of your system's volatility, your time horizon, and the statistical probability of a significant drawdown. For a quantitative system, the cash threshold is determined by the maximum expected drawdown over a specific period, plus a safety margin. If your model suggests a 15% maximum drawdown in a 3-month period, your cash reserve must be sufficient to cover that drawdown and still allow you to execute your strategy without disruption. This is a defensive measure. The offensive measure is the opportunity threshold. This is the amount of cash you need to deploy to take advantage of a 3 sigma event. If a market crash offers assets at a 40% discount, and you wish to increase your exposure by 20% of your total portfolio value, you must have that 20% in cash, ready to deploy instantly. Therefore, your cash position, $C$, is a function of 2 variables. $C equals text drawdown safety, text opportunity, capital dollar. This is a dynamic calculation. When market volatility is historically low and asset prices are statistically extended, the probability of a sharp correction increases. In this environment, your drawdown safety component should increase, and your opportunity capital component should be fully funded. Conversely, when the market has just experienced a significant correction and assets are statistically cheap, your opportunity capital may be deployed and your cash position will temporarily decrease, but the system must immediately begin rebuilding that reserve. The key is that the decision to increase or decrease cash is algorithmic. It is triggered by a change in the statistical environment, not by a news headline or a gut feeling. The moment emotion enters the equation, the mathematical advantage is lost. To illustrate this necessity for precision, consider the field of structural engineering. When a bridge is designed, the engineer does not simply guess at the load-bearing capacity. They calculate the maximum stress tolerance based on known material properties and the statistical probability of extreme weather events, wind shear, seismic activity, and maximum traffic load. They then build in a safety factor, often 2x or 3x the maximum calculated stress. This safety factor is the engineer's cash reserve. It is capital that is not working in the sense of maximizing the bridge's length or minimizing its material cost. It is a deliberate, mathematically justified inefficiency that ensures the system's survival during a tail event. The emotional investor builds a bridge with a safety factor of 1.01, believing they are maximizing efficiency. The quant builds a bridge with a safety factor of 2.5, understanding that the cost of failure is infinite, while the cost of the reserve is finite and predictable. Your cash reserve is the safety factor of your financial structure. It is the redundancy that prevents catastrophic failure. Furthermore, the calculation of the drawdown safety component must account for the duration of the crisis. A 15% drawdown over 3 months requires a different reserve than a 15% drawdown over 3 years. The cash must be sufficient to cover all operational expenses, margin calls, and strategic rebalancing needs for the entire statistically probable duration of the crisis. This is where the emotional investor fails. They plan for a V-shaped recovery, which is a hope, not a statistical certainty. The quant plans for an L-shaped stagnation, which is a possibility that must be mathematically accounted for. The cash reserve is the time dilation factor that allows you to wait out the irrationality of the market without being forced to act. The second lesson is to understand cash not as a zero return asset, but as the perfectly non-correlated hedge. In a crisis, almost all asset classes, stocks, bonds, real estate, commodities, tend to correlate toward one. They all fall together. This is the moment when diversification fails. The emotional investor, the quant, understands that true diversification is not about holding different assets. It is about holding assets that behave differently under stress. Cash is the only asset that is guaranteed to maintain its nominal value when the market is in freefall. Its correlation to the market is, by definition, zero in terms of nominal price movement. Consider a portfolio with a 10% cash allocation. When the market drops 30%, the 90% invested portion loses 27% of its value. The 10% cash portion loses nothing. The total portfolio loss is 27%, not 30%. This is a simple, linear benefit. The nonlinear benefit is the psychological one. When your portfolio is dropping, the cash reserve acts as a psychological anchor. It is the one part of your balance sheet that is stable. This stability is critical because it prevents the emotional, panic-driven decision to sell. The emotional investor sells because they see their entire net worth eroding. The quant sees the erosion, but also sees the stable cash reserve, which is now proportionally larger and more powerful. This reserve is the rational counterweight to the market's irrationality. I recall a period in the early days of our fund when a specific model, which had been highly profitable, suddenly began to underperform. The drawdowns were significant, though within the statistical boundaries we had set. The pressure from some of our early partners was immense. They wanted to abandon the model to do something. Our response was to simply increase the cash allocation, not by selling the underperforming assets, but by reducing the leverage and reallocating incoming capital. This was not a move of fear. It was a move of systemic integrity. The cash reserve bought us time to analyze the model's failure, time to adjust the parameters, and time to wait for the statistical regime to shift back in our favor. Without that cash, we would have been forced to make a permanent emotional decision based on temporary statistical noise. The cash reserve was the firewall between our logic and the market's hysteria. Let us delve deeper into the concept of tail risk. Tail risk refers to the possibility of an event that is several standard deviations from the mean, the extreme, low probability, high impact events. The emotional investor dismisses these events because they are rare. The quant, however, knows that in a non-Gaussian distribution, which all financial markets are, these tail events occur far more frequently than standard models predict. This is the fundamental flaw in relying solely on the normal distribution. Cash is the only asset that provides a guaranteed offset to this non-Gaussian tail risk. Imagine a scenario from military strategy. A general is planning a campaign. They allocate 95% of their resources to the primary offensive, maximizing their chance of a quick victory. The remaining 5% is held in reserve, a non-committed force. This reserve is not working in the battle, but its existence changes the entire probability landscape. If the primary offensive encounters an unexpected 3 sigma counterattack, a tail event, the 5% reserve is the only thing that can prevent a rout. It is the force that can be deployed to plug the breach, stabilize the line, and allow the main force to regroup. If the general had committed 100% of the forces, the tail event would lead to total collapse. In finance, the market crash is the unexpected counterattack. Your cash reserve is the strategic reserve force that ensures the survival of your capital structure. The cost of this reserve is a known, quantifiable drag on returns. The benefit is the non-quantifiable survival of the system. The quantitative mind always prioritizes the survival of the system over the maximization of short-term returns. A system that survives every crisis will, by mathematical necessity, outperform a system that maximizes returns but fails once. Cash is the ultimate tool for ensuring its survival. It is the mathematical certainty of solvency in a world of statistical uncertainty. The third lesson is the discipline required to execute the buy order when the market is in a state of maximum fear. Holding cash is the preparation, deploying it is the execution. And execution is where most people fail. The emotional investor, having successfully held cash through the bull market, suddenly finds themselves paralyzed when the crash arrives. They see the news headlines, they hear the pundits predicting the end of the world, and their rational mind is hijacked by the primal fear of loss. They wait for the bottom, a concept that is statistically meaningless. The bottom is only known in retrospect. The quantitative investor does not wait for the bottom. They wait for the statistical signal. The signal is not a price level. It is a deviation from the mean that exceeds a predefined threshold. When the market has fallen 20%, 30%, or 40%, and the statistical models indicate a massive mispricing, the buy order is executed. The key is that this decision was made months or years in advance, in the cold light of day, when the market was calm. The cash reserve is deployed in tranches according to a preset schedule. This is crucial. You do not deploy all your capital at once. You deploy 25% at the first signal, another 25% if the market falls, another 10%, and so on. This is a strategy of mathematical averaging that removes the need to predict the exact low point. It ensures that you are participating in the recovery regardless of when it begins. The emotional investor views a 25% deployment followed by a further 10% drop as a failure. They feel the pain of the loss on the deployed capital. The quant views it as a successful execution of the plan, which now allows for the purchase of even cheaper assets with the next tranche of cash. The goal is not to be right on the day. The goal is to be mathematically correct over the entire cycle. This discipline is the final barrier between the amateur and the professional. The professional has a system that dictates action. The amateur has a feeling that dictates hesitation. The cash reserve is the physical manifestation of that system. It is the bullet in the chamber, and the discipline is the finger on the trigger, waiting for the precise, pre-calculated moment to fire. Let us examine the psychological friction of deployment. The moment of maximum opportunity is also the moment of maximum psychological pain. The market is a sea of red. The news is apocalyptic, and every instinct tells the human to retreat, to conserve, to wait for certainty. This is the cognitive bias that the quantitative system is designed to override. The system must be emotion-proof. The algorithmic deployment strategy is the mechanism for this override. It is a simple, pre-programmed rule set. For example, a deployment algorithm might look like this. Signal 1, correction market index, is 20% below its 200-day moving average. Deploy 25% of opportunity cash. Signal 2, market index is 30% below its 200-day moving average. Deploy 35% of remaining opportunity cash. Signal 3, capitulation. Market index is 40% below its 200-day moving average, and the VIX volatility index is above a predefined historical peak. Deploy the final 40% of opportunity cash. This is a simplified example, but the principle is clear. The decision is a function of measurable, objective data points, not subjective fear. The emotional investor will look at signal 3 and see a reason to panic. The quant sees a statistical anomaly, a temporary mispricing that is mathematically guaranteed to revert to the mean over time. The cash reserve, held in readiness, is the only thing that allows the quant to capitalize on this anomaly. The deployment of cash is not an act of bravery. It is an act of mathematical inevitability. It is the closing of a statistical loop. You held cash because the probability of a crash was non-zero. The crash occurred, and the probability distribution shifted. Now, the probability of a significant rebound is high. The system simply executes the logical conclusion of the initial premise. The emotional investor is playing a game of chance. The quant is executing a probabilistic arbitrage against the collective irrationality of the market. The final crucial point on deployment is the immediate reestablishment of the cash reserve. The moment the cash is deployed, the system must begin the process of rebuilding it. This is the principle of systemic equilibrium. You do not deplete your reserve and then hope to rebuild it. The rebuilding process is an integral part of the strategy. It means that as the newly purchased assets appreciate, A portion of the gains is systematically harvested and converted back into cash, preparing for the next inevitable crisis. This ensures that the system is always robust, always prepared, and never caught flat-footed. The cycle of preparedness is continuous, not episodic. The fourth lesson, which is intrinsically linked to the concept of systemic survival, is the role of cash as the ultimate antidote to the leverage trap. Leverage, in its purest mathematical form, is simply the amplification of returns. But in the hands of the emotional investor, it is a catastrophic multiplier of risk. The emotional investor uses leverage to maximize returns in a bull market, believing they are accelerating their wealth creation. What they are actually doing is eroding their safety factor and introducing a nonlinear fragility into their system. Leverage turns a manageable drawdown into a forced liquidation. It is the mechanism by which a temporary market fluctuation becomes a permanent loss of capital. The quantitative mind views leverage with extreme caution. It is a tool to be used only when the statistical edge is overwhelming and the system's integrity is absolutely guaranteed. And the only way to guarantee that integrity is through a robust, non-leveraged cash reserve. Consider the margin call. A margin call is not a financial event. It is a mathematical ultimatum. It is the moment when your system's liquidity falls below the threshold required by the counterparty. At that moment, all your rational analysis, all your long-term conviction, and all your statistical models become irrelevant. You are forced to sell, not because your model says to sell, but because the system's lack of liquidity dictates it. You are no longer the master of your own capital. You are a slave to the counterparty's rules. Cash is the unleveraged buffer that makes the margin call mathematically impossible under all but the most extreme predefined scenarios. If you maintain a cash reserve that is sufficient to cover 3 times your maximum possible margin requirement, you have effectively immunized your system against the emotional panic of forced selling. This is a lesson I learned not in finance, but in the early days of my career, dealing with complex, high-stakes mathematical problems. When you are solving a problem with a nonlinear solution space, you must always have a nonlinear reserve of time and resources. If you commit all your time to a single path, and that path proves to be a dead end, you have no time left to pivot. The pressure to find a solution becomes immense, and the probability of error skyrockets. The reserve of time is the cash. It allows you to step back, reevaluate the data, and approach the problem from a different angle without the pressure of an imminent deadline. In finance, the pressure is the margin call. The cash reserve is the time and space you buy to allow your models to work, to allow the market to revert to its statistical mean, and to allow your logic to prevail over the collective madness. The emotional investor sees cash as a low-return asset. The quant sees it as the ultimate deleveraging tool, a non-negotiable component of a system designed for perpetual survival. Without it, any use of leverage, no matter how small, is an invitation to systemic failure. The king of the market is not the asset that goes up the fastest. The king is the asset that guarantees your survival when everything else is collapsing. That asset is cash. In conclusion, let us distill these principles into the core tenets of the quantitative mindset regarding capital allocation. First, cash is not a position, it is an option. It is the non-correlated asset that grants you the right, but not the obligation, to purchase assets at statistically improbable prices. Its value is not its yield, but its optionality. It is the computational power held in reserve, ready to test a new hypothesis when the data demands a pivot. Second, liquidity is the ultimate defense against tail risk. A system without sufficient liquidity is a system designed for failure in a crisis. Your cash reserve must be a function of your maximum expected drawdown and your desired opportunity capital, calculated with the precision of an engineer's safety factor. It is the firewall between your logic and the market's hysteria. Third, preparation and deployment are algorithmic. The decision to deploy cash must be made in advance based on statistical thresholds, not on emotional reaction to market news. The buy order must be executed with cold, calculated precision when the market is screaming in fear, and the reserve must be immediately rebuilt as part of a continuous cycle of systemic equilibrium. Fourth, cash is the antidote to the leverage trap. It is the unleveraged buffer that ensures systemic integrity, making you the master of your own capital and immune to the mathematical ultimatum of the margin call. The world of finance is a complex system, but its complexity